So thank you very much for being with us, the four of you. And maybe, Helen, I pass over to you first to give us a little bit of a sense, and then I pass over to you, Nadia, kind of in a way as a double act between the two of you, if I can say that, a little bit setting out the work of the subgroup around usability and data, because ultimately this is where the rubber hits the road. That's where the taxonomy is actually, to be implemented or made implementable, if that word exists. Helena, maybe I pass over to you first.
Thank you so much, and good morning to everyone. Nadia and I, as Nicholas said, we lead on the data and usability subgroup, whose role is to advise the European Commission on data and usability and on the development of sustainable finance policy issues. Now, all of you can imagine that reporting has taken or has represented an important bulk of our work over the past months. And although the only legal obligations linked to the taxonomy is one of reporting, reporting is never the end goal. It's always the means towards. And in the case of the taxonomy, the goal is twofold. The first one is to provide clarity to investors. So if you invest, if you market your fund as green, that is that it has an environmental objective or environmental characteristics, it's only fair to ask how green it is. And the second goal is a much bigger, if you wish, which is to help finance the transition. It is to help narrowing that investment gap that exists today in Europe that is calculated of 300 billion euros of additional investments per year if we are to meet the 2030 environmental goals. So let's look a little bit closer to providing clarity to investors. So basically what we're aiming towards is to say, for all of us to be able to say to our clients, for each euro that you invest in this fund, 30 cents, 40 cents, 60 cents are actually invested in green. In fact, what we want to be able to investors to tell their clients is to say 20 cents are invested in water, 10 cents in climate mitigation, and so forth. But because we know there is a difference in investing in already green activities as opposed to investing in transitional activities, therefore you need also to provide that nuance. It is also worth highlighting that the taxonomy allows for capturing and reporting the CapEx, those investments that are made in order for companies to transition. So also quite important. It is also important to tell our clients to say, well, what happens with the other 40 cents in the case I was presenting on the rest of the fund? And here is where we need to be clear about how much is invested in asset classes that, at least today, the taxonomy cannot be applied to: cash, sovereign debt, but also how much is invested in activities that could be green, but they're not yet there. And following what Nathan was talking about, the traffic lights, maybe one day we also can report and tell our clients, how much is invested in red or in amber. But if I wrap up on that point, what we are basically saying is that in order to be able to tell your clients how much is invested in for every euro, all the denominators need to include all the assets. Yeah, so the fund, has to cover all the assets, and in turn, that's the same for the constituents of the fund. But it also means that the reporting at fund level needs to be accompanied by additional disclosures, and I mentioned some of them. When it comes to Article 8, as many of you know, Article 8 was included in the taxonomy regulation a little bit at last minute, but the main purpose of that addition was to help investors, to facilitate the task of investors. And that means that there needs to be, and this is fundamental, consistency between Article 5, 6, and 8. And it also means that the approach we have for financial institutions that fall under the scope of Article 8 needs to be the same. And I like to think, at least I like to think, that there was another reason to include Article 8. And that one was to include bank lending. Because somehow inexplicable, bank loans were excluded from the taxonomy regulation. And if we think that in the EU, more than 45% of the external funding of non-financial corporates comes from bank loans, then we all know that unless we include bank lending and unless we have banks on board, we will not find the necessary funds. And this means that when it comes to banks reporting, what is really crucial is the credit portfolios, and that includes their European and non-European exposures. And I think I'm going to leave it here and pass it over to Nadia. Thank you.
Interesting. There'll be 1 or 2 points I will come back to on what you've said so far, but please, Nadia, maybe over to you, looking at the other side of usability, how you divide things up with Helen in the subgroup.
Yeah, absolutely. And thank you very much for inviting me to speak with Helena today on your panel. It goes without saying I agree with everything Helena has said. So there are many ways an investor can use a taxonomy. One thing I would like to say is it's not intended to be a compliance checkbox. We really do want the taxonomy to be ingrained in investment workflow. So we don't want people just to score their portfolio annually, distribute to asset owners and consider it to be done. And I think there's some clever architecture in here when you see the changes to things like suitability under the MiFID II infrastructure. The dialogue between the investment manager and their clients will change. And it'll introduce direct questions related to client sustainability preferences, which I think is really exciting. Because today what we see is investment managers can make a number of claims about the sustainable nature of their products. And that may hamper the ability to kind of evenly compare these products with ESG characteristics. Hopefully, using the taxonomy will help to normalize the language used and make products more comparable. And ultimately, I think it doesn't really stifle creativity. One of the challenges I often hear when I'm on a panel is my portfolio scores really low. I don't think it's indicative of kind of the sustainable nature of my investment. I'm very worried about the first disclosure I need to make. But actually, the stewardship piece of the role that will encourage and work with companies to help greenify their operational processes with this dictionary or guide path that is the taxonomy, I think really excites me. Also, I think Helena mentioned that you don't have to just use, for example, turnover. You can look at an investment strategy where a company is employing, I don't know, greater than 20% or 50% of their capital expenditure towards improving its operational processes in line with the taxonomy. So it's not just a backward-looking metric, it's very much forward-looking and supporting the transition. A couple of things, because we do sit in data and usability, and you've directly asked me a question about what we're doing here. So we do read through recommendations, not just, I know I've spoken about investors, but not just from an investor's point of view. We also look at it from a corporate disclosure point of view. Are we equipping corporates with the information they need in order to satisfy their reporting obligations under the taxonomy? We also look forward to the review periods. So there's one mentioned in the draft Article 8 Delegated Act, which talks about reviewing things like the inclusion of small and medium-sized enterprises, the inclusion of sovereigns. And so the data and usability team will work to provide recommendations on how to incorporate those. I recognize we have a number of panelists. I have a few other things to mention, but I'll save them for later questions. Thank you.
And again, Nadia, you raised already a few questions in my mind as well, which I will come back to. The one just to mark already, which I find fascinating, is many see this still as a disclosure exercise, but actually it's much more. It's building it into all of the processes, customer relations, risk management. And I would like to come back to that, something we will discuss with the supervisors tomorrow. But maybe I can pass over to you, Sabine, because in a way you play an important role as a intermediary, as a service that helps aggregate some of this information, make it usable for the investor community or the wider financial services community. And you've been working on all kinds of use cases to kind of feed this into the day-to-day processes for financial institutions. And I'd love to hear your initial views and thoughts on that and what you've heard just now.
Yeah, and thank you very much, and happy also to share that panel. As the cornerstone of the EU Sustainable Finance Action Plan, the EU Taxonomy will have definitively a transformative impact on the Europe financial ecosystem by fostering transparency and encouraging investment flows into green activities. And it's all about our future and its sustainability and inclusiveness. And the most important is the market preparation and our readiness to support the effort, as it was already mentioned. The taxonomy will help build investor trust around financial products marketed as green or sustainable over time, which will ultimately be positive for market growth and investment flows. And of course, we're investing a lot also to be ready to support both investors. You were mentioning asset managers, asset owners, sovereign, but also non-listed companies, but also small and medium one. The legislation will also fundamentally affect all actors in the financial markets. And it's very important that we contribute to support the common language on the sustainability asset activities, which is spread thanks to the European taxonomy. And this will help protect also the so-called greenwashing. When we were preparing that panel, I was also talking about the EU taxonomy washing. Very important that we support that communication and alignment in order to help relevant stakeholders to focus on the action they have to take to be impactful. And you were talking about the reporting before disclosure. It's absolutely of essence that also we contribute to engage and to have issuers engage with us in order to improve and accelerate that engagement. Last but not least, also very important, we all know that the private sector will have to be hugely engaged to support the additional, 350 billion per annum, which is required to really make it, and achieve the goals. And again, our role through our methodology, through the data, the quality of, again, engagement with issuers, but also investors, are really keen to support this trust to be spread, and also the better connectivity between the different communities contributing to that effort.
Thank you. Again, an important point around trust and the trust of data, reliability of data. I would like to come back to that. In this opening kind of first reflections, Stefan, you're kind of here as kind of an end user, so to speak, of all these things that are being done, the obligations that might be put on you into building this into your processes. How do you see this? How do you see the usability aspects of these taxonomies, or the taxonomy in different parts that is being developed at the moment?
Thank you. Good morning from Frankfurt. And indeed, we have at DWS, we are obviously one of the biggest European fund managers, and we are applying now an ESG first approach, which basically means that we are now really concentrating on our ESG product suite, which is the new normal rather than a niche. And obviously, when setting up these funds, there will be a range of, how should I put it, deep green to slightly green and impact and other funds. And what we have found so far on the taxonomy, it's an incredibly important tool to help the transition and to look at what constitutes green. But when it comes to setting up investment funds, it's currently of only limited usability. And you can see that in a study that the German Investment Fund Association, BDI, has issued a few weeks ago, which just modeled a standard DWS portfolio according to Article 8 of the Sustainable Finance Disclosure Regulation. And they found that if you use this Article 8 approach, and if you use standard exclusions, you find a very low taxonomy alignment for the moment. It was in that model, it was actually less than 4%. And it's not that that we are trying to avoid the taxonomy or not use the taxonomy. It's the way the taxonomy is set up at the moment. I think lots of what was said earlier by other speakers, by Martin, also by Elena, will help increase that alignment. I think it is very important to manage expectations for the moment. The expectation that we will reach a high percentage rate of taxonomy alignment, let's say something around 50 or even 90%, as some have suggested, is mistaken for the moment. What we can only achieve is an alignment that obviously goes up from 4%. And the reason I'm saying that is obviously we have a clear definition of the taxonomy at the moment only for climate. When we get other economic sectors into the taxonomy, or sorry, other the technical screening criteria into the taxonomy, that will increase. When we get other economic sectors into the taxonomy, that will increase as well. But we also face the challenge that we have a narrow framework, as I mentioned, also when it comes to the no significant harm barriers and the minimum safeguards. So it's for asset managers at the moment, even with the best will in the world, it's difficult to reach that taxonomy alignment. So we're obviously waiting with bated breath for the Article 8, in this case, Article 8 of the taxonomy regulation, delegated acts today, which should give us a bit more of a view into how taxonomy aligned an investee company is. So that obviously will also improve. But again, it's really to manage expectations. If we look at the data, that 4% I just managed won't just become magically 40% or even 80%. It will gradually maybe come up to double-digit numbers. And then maybe in the second half of the 2020s, we will see a growth. But at the moment, the taxonomy is of limited use. And if I may, I would like to make a second point, and that is the question of comparable data and need for standardization. What we have at the moment is that we are using the ESG rating providers, which obviously are helpful to us, but we have made the case in the past and would like to make that case again. We need some standardization and some regulation to make sure that the data we're using as a proxy and as an approximation, which we have to do quite a lot for at the moment for the reasons I've just outlined, that this becomes more comparable. At the moment, if you speak to DWS, if you speak to other asset managers, what ESG ratings providers do in terms of methodology, in terms of cost, is a black box for us. Obviously, we're using them. We are big enough to use all of them. So we can take a, let's say, middling approach of all the data we are having. But obviously, middling data or just averaging data, where you're not quite sure what the methodology is, again, is not ideal. So the Corporate Sustainability Reporting Directive will again be something that we can use quite heavily, but it will take a few years to bed in. So finally, just to manage expectations on how fast we can move with the taxonomy, obviously DWS and also our main shareholders, Deutsche Bank, are doing quite a lot to make sure that we can apply the taxonomy to asset management, also to our loan books, by the way. That would be an interesting one for Deutsche Bank to discuss. But again, there are quite a few challenges that will be overcome by the Article 8 taxonomy delegated acts that will be overcome when the taxonomy grows, but it will take time.
Follow up on that with you, Stefan, and then I bring Sabine in as well, which is, so the figure of 4%, what are the barriers, or if you were to rank the barriers, is it that the regulatory framework is still under construction? So, we've got the SFDR, we've got the CSRD just as a proposal at the moment. Parts of the taxonomy are still not operational, in the sense delegated acts haven't been adopted yet. So is it legal and regulatory uncertainty, one possibility? Is it just the lack of existence of data, which might be a result of that or not? Is it the lack of standardization of that data? Is it, as you say, lack of harmonization around intermediaries that provide this type of data? Or is it kind of different views that people have still about what is green, what's in the taxonomy or not? I'm not calling it greenwashing, but some kind of reinterpretation or different interpretations around the whole space. Or is it just a question of time? Is it kind of, getting the systems going, getting us Nadia said previously, getting the internal structures going. How would you rank, maybe I forgot something, but if it's those, how would you rank those different challenges?
I think you named quite a lot already. So let me rank what you said. And it's indeed all of the above. So you're right. But if you look at the let's say, reasons and the causality that I just mentioned, for the moment, the taxonomy covers only 1/3 of economic sectors. And it also has got clear criteria that obviously are still being applied in terms of climate mitigation and climate adaptation. So obviously that is the key reason why it is very difficult to really pin down the taxonomy alignment of investee companies when it comes to asset management. By the way, that's also true, as I mentioned, if you look at Deutsche Bank in its loan book. If you do a general purpose loan or retail loan, it is difficult to pin down what that money is being used for. But actually, again, that is something that we will see maybe solved in a better way when we get the delegated acts. So it's firstly that narrow framework of the taxonomy, which obviously is not a criticism because it is being developed as we speak, and we heard quite a lot this morning already on how it's being further developed. So this is, I mean, the main point. And then if you look at how we can, for example, look at our investee companies, we can use approximations, and we have data providers that can give us these approximations. But obviously these are, as I mentioned, sometimes contradictory, sometimes not entirely clear how they're being made. We are using them nevertheless, but to actually increase confidence in the market and also make sure that smaller asset managers and smaller banks can use it. Some degree of standardization, some degree of regulation there would be immensely helpful. So I hope that answers the question to an extent.
Thank you very much, and I think we will see some aspects of that in the next development of the Commission strategy around the use or obligations on some of the intermediaries. But before I come to Nadia, because I know you have views on this as well, just Sabine, because I know you've been kind of, even in this environment of still a lot of uncertainty that Stefan has just highlighted, you have been working on use cases. You are preparing for this. So what have you been doing? What are some of the examples you've seen operating in this period of, I wouldn't say uncertainty, but still things under construction, so to speak?
Yeah, thanks. Excellent question. And it's all related to also the importance of the trust we were talking about, and the fact that there is that perception of ESG agency to be a kind of black box. Very, very importantly, we are really targeting to not only contribute to build, and contribute to build the standardization, but also we are working a lot, and this is why I was mentioning the engagement with the issuers, okay, which are reporting, of course, information, but also with small and medium enterprises, so that we can drive accurate data toward the market. And based on a dual materiality methodology, we are also providing, especially when we're launching new products to answer market needs or needs market participants consider that they are not enough supported, to include them into proof of concept, into iteration or iterative work, so that that trust exists between investors and us, but also between issuers and our agency. So to make a long story short, dual materiality, the very strategic concern and dedicated means to engage with issuers, but also to continue to develop that trust within the investors, asset managers, asset owners, sovereign, the custodian, etc. And last but not least, also to provide the opportunity when we're answering needs or unmet needs, by listening our clients, but to share with them when we're providing to the market new products or products we are enhancing, proof of concept and way to contribute to really trust the final product which is delivered.
Thank you very much indeed. I think, Nadia, can I come to you? Because I know you've looked at some of these questions around standardization, and you might have some other thoughts on what you've heard, but you've looked at this question of standardization. One of the key issues from the beginning was, can we integrate this with the NACE codes, for example, which exist or not? And some people say it's very convenient, others say they're not really used to that. How do we build on existing standardization models to help Stefan around some of these aspects? And then I will come back to you, Helene, as well, of course.
Thanks, Nicholas. Yes, I will absolutely talk to that and maybe answer your original question. While I agree with my panelists, I think there are 4 places that we can start to focus on data. So if you think about how to construct a taxonomy report, you have step 1, which is identifying eligibility. Step 2, demonstrating substantial contribution. Step 3, do no significant harm. And step 4, minimum social safeguards. So if it's okay, I'll just explain roughly how you can and what you can lean on in order to do those 4 things, and maybe answer some of your questions around data availability and suitable proxies or equivalent. So if we start on eligibility, the first step is to say whether what I am doing can at least be tested under the taxonomy framework. It's worth qualifying that eligibility doesn't mean green. It just means it's covered within the taxonomy. And as you rightly point out, NACE codes are used as the nomenclature framework within the delegated acts that explain the context of the activity. But actually, to really understand the activity, you do need to read within the delegated act. NACE has some limitations. It doesn't cover at the current state all of the renewable technologies, for example. So what we've been doing in the data and usability subgroup of the platform is working across a suite of vendors who provide classification frameworks. And we aim to publish pretty soon a mapping exercise that says for a taxonomy activity, what's the equivalent using GICS, BICS, TRBC, so frameworks that are currently used by investors today, and often with a lot more granularity that allow them to be more cleanly mapped to the taxonomy. The second thing I would say is substantial contribution. And I think your criticism is something I hear very often. Firstly, the criteria are too tight, not achievable in today's current practice. Secondly, it's looking at activity level metrics. Actually, observed reporting today is entity level. So how do you manage to report under such a framework? I guess my answers there would be climate change, biodiversity loss, resource depletion are all urgent challenges. We do have the technology and creativity to create a sustainable economy, but what we also need to look at is, and I think Stefan made this point really clearly, the definition of good or environmentally sustainable varies. Quite often it's driven by some kind of rating or score program. And sometimes in that variety, false claims can be made. And as we start to see national governments really focusing on what it takes to hit their net zero commitments, we do need a clear and common language that says, if I'm making cement, what contribution can I make to substantially contribute to mitigation? What do I need to do as a practice to adapt my business against the risks of climate change? And so for substantial contribution, we do need to make rules, set KPIs, and have measurable targets. And that's what the taxonomy aims to do. Now, when you start to think about practical application, you could say a car manufacturer is 100% eligible because arguably everything they do could qualify under the taxonomy. Doesn't mean that car manufacturer is green. What we're then looking for is a substantial contribution. And that ultimately means what revenue or capital expenditure are they putting forward to producing cars whose tailpipe emissions are less than 50 grams of carbon per kilometre traveled. And if we even look at, for example, the hybrid vehicles you see on the streets today, they're typically operating around 100 grams. So 50 grams is a tight target. And really, when you're looking at revenue, you're looking at the zero emission vehicles within that. So yes, the criteria are tight, but I think they need to be. I'll quickly move to do no significant harm. Now, this is where we hear kind of most concern. It points to a lot of EU legislation, and as Helena mentioned at the outset, really we want the taxonomy to be ingrained in investor workflow. It has to apply to non-EU companies in order to make sense to an investor community that have existing ESG funds. So how do you apply do no significant harm? It's looking specifically at activities, and some might argue it's looking specifically at projects. So under biodiversity, one of the criteria is regarding an environmental impact assessment, and that typically is conducted for a project, not for an entity. So if I'm looking at an equity or I'm looking at an entity level disclosure, what do I need as a proxy relative to environmental impact assessment? Do I need to know that any projects in the last series of years have at least had an environmental impact assessment? And that could be an appropriate proxy. I think one of the things that I also hear is perfection. Do no significant harm requires you to get an A in your test rather than a B+. There's no scale. Actually, in the technical expert group, we did recommend a risk-based approach to do no significant harm. And for the state of disclosure today, I think that could be operable. When we think about it from a debt or project perspective, do no significant harm needs to be met at maturity of that project. When we look at it from an equity or overall entity disclosure perspective, the expectation is you're doing no harm today. And that might be a step too far for some organizations right now, and they'll need investment to meet the do no significant harm requirements. And then finally, if we're looking at minimum social safeguards, this leans on pre-existing and well-established frameworks. It is an entity level assessment of a company. And really you're looking at OECD guidelines on multinational enterprises, the UN guiding principles, the 8 fundamental conventions of ILO, and the International Bill of Human Rights. Within the data and usability group, we've looked at kind of the nature of international disclosure. We've looked at roughly 10,000 companies, and across those companies, we are seeing reasonable adoption of human rights policies, making sure they have anti-corruption and bribery, making sure that they're reporting on diversity metrics. So I feel confident that at an entity level, there's less concern with minimum social safeguards. I've spoken a lot, apologies, but I thought it would be useful to kind of run through those 4 issues.
No, I think it was very, very helpful. And actually, to be honest, there's 3 very good questions that have come in, which I will ask you, but also Helene, when I pass over to you, please also respond to them as you feel fit. But they feed quite nicely into the things you've just said, Nadia, which is in no particular order. One is maybe come back to your point about the mapping exercise. How do we map existing standards and practices against things? Because, there's always been the fear that we're now moving to some new standard, but nobody quite knows what it is. And what you're saying is, no, you can use existing standards, TCFD, other standards that are out there to build. But how do we then avoid, again, chopping and changing, or kind of you pick a bit the ones that you like the most, so that we go back into the danger of greenwashing? So how do we use existing practices, but in this promote standardization and simplicity? I think the key question is simplicity. The second question that I got was around what you said about cars, for example, works really quite well in the corporate space, but when we go into the financial services space and they have to look at their OPEX and CAPEX, they're one step removed from their underlying customers. So how do you manage that through the chain, so to speak? And the third one is, how do you feed into the internet, or how, in a way you've answered it, but how do you build on existing international standards? Be that now the work that's being done by the IFRS Foundation, but also kind of all the existing international standards. Maybe pick 1 or 2 of those and then Helene the others, but just those are the questions that came in so far.
As I've spoken a lot, maybe I'll offer Helena the opportunity to come in on her favourites, and then I'll pick up what's left over.
Yeah, the 2 of you know each other well enough, so then over to Helene first.
Okay, thank you, Nadia. I wanted to pick up on 3 points or 3 issues that have been raised and on the questions, and then I will leave the others for Nadia. The first one is really important on the methodologies that Stefan referred to. So the first point I would say is that excluding non-European large companies from fund reporting from Article 5 and 6 makes little to no sense. And I would even expand that comment to financial institutions. And to cut a long story short, the main reason is because we wouldn't be able to provide clarity to investors if we exclude them, not least because roughly around 70% of the funds in Europe that are marketed as ESG or having an environmental objective include non-EU constituents. So that's the first point. Also, let alone that, as we were saying, it's not only about reporting, it's also about influencing decision-making and about helping investors to create the portfolios and to progressively reorientate those investments. So the question is, well, because we're not, we cannot ask non-European companies to disclose against the taxonomy, what do we do? And here is where the methodologies and the estimation, to do some sort of estimation on what that alignment is becomes really important. And it's needless to say that at least when it comes to Article 5 and 6, if they are included in those funds, it's because there is a certain level of information on the environmental side. Otherwise, what are they doing in a fund that it is commercialized as having an environmental objective or environmental characteristics? So the reality is that we need those methodologies to facilitate the investors' work. And then the problem is, how do we ensure that there's no greenwashing, which I think it is the direction that Stefan was pointing out to. And what we are recommending is, number one, for the European Commission, and they can decide if they want to delegate it to the platform, to develop a set of criteria, mandatory criteria, that all those methodologies need to meet. And at the same time, at quite a high level of transparency from the investor side when they disclose the part of the fund for which they have estimated alignment, that gives that reassurance. So from what methodology they used to who was the data provider. We have even considered, and this is still under consideration, that there is a possibility of having those methodologies some sort of pass a sort of like a test, if you wish, or get some sort of approval. But what is, and I think it is a huge message from our side, what we cannot deny, it's the incredible contribution that data providers and other analysts are doing in really moving forward, the taxonomy agenda, in getting the information from the companies, in actually, improving the efficiency of the taxonomy. So we are at a very early stage. We are so far away from developing or saying this is the one methodology that needs to be used, that we need to really encourage the market, let this army of analysts, do their job, and then let's just frame it and give that reassurance that everyone needs in terms of the methodologies used. Very quickly on the point you also made in terms of consistency and the evolution of data, and consistency not only between Article 5, 6, and 8, but more broadly, consistency across all reporting requirements and reporting regulations. Let's be honest, what we have today is different regulations that they're being developed at the same time and different standards in parallel, So what we really recommend, and I think the European Commission has really listened to us and they agree with us, and the ESAs also have recommended, is that in 3 years' time, we need to review. We need to stop and say, okay, now that we have more clarity on what the CSRD, asks for, now that we have clarity on whether or not we're going to develop that traffic lights taxonomy, whether or not we're having a social taxonomy, and we have more clarity around the data availability, on how fast that availability is improving, not only in Europe, but outside of Europe, because let's not forget that the rest of the world is also working on ESG reporting and is asking more and more, increasingly, more data availability. Let's just stop there and let's review, and let's then tighten up all those regulations. A clear example is if there is that traffic lights taxonomy, then The question is, do we really need the RTS, the principal adverse impacts on environment that they are in the disclosures regulation, or do we use, that significantly harmful activities as a much better indicator of the do no significant harm within funds? I think the answer is quite obvious, because it's almost like for food products that if you just disclose the percent, the quantity of one product has on a substance, none of us would know whether that is too much or not. You need to contextualize. And the work we're doing is to contextualize environmental metrics within really clear economic activities. Yeah. And today, the majority of the principal adverse impacts, they're just indicators with no context. They don't take into account, the sector or the risk factor. So I think I'm going to leave it here, because and then let Nadia take on the mapping question and add to anything that I said. Thank you.
Just before I do that, just one thing, it's interesting. Yes, I've been saying for a long time that 2024 will be a period of, I wouldn't say steady state, because there's never a steady state here, but there will be a bit of a steady state because different pieces will be in place. We will see roughly what the building will look like. At the moment, we're just seeing bits and pieces being built, staircase and a bit of a chimney and stuff, but we haven't seen the whole thing together. And I agree with you, as long as it doesn't lead to a whole new review of everything, there's a lot of overlap, a lot of confusion that could be streamlined between the different disclosure regimes and other rules. So it's very encouraging. I think, yes, Nadia, over to you. Kind of how can we make mapping as simple and easy as possible? And one other question that came in, I throw in as well, is on the do no significant harm principle. How do we apply that to non-EU companies? Because ultimately it's kind of, if you're a bit cynical, you could say you're exporting European norms and regulation onto those companies, but without those companies necessarily being experts in European law. And I heard this actually from a number of Japanese companies that are saying, look, we can't be spending all our time tracking European legislation standards just because we want to invest or want to provide loans in Europe.
Nicholas, yeah, absolutely. I love the building a house. I'm going to steal that from you and use that as an anecdote in other panels. I think that's a particularly strong one. So I'll try and tackle your questions one by one. So mapping exercises, things, for example, like TCFD. So within the taxonomy, we ask about adaptation. My expectation is that a company would have done a TCFD-like review of their business before starting to adapt it. They would have governance, strategy, risk management, and at least set a kind of core metrics and targets around that. And now we're asking under adaptation that they favour nature-based solutions in remediating the climate risks that they may have identified, but I see them as very complementary regimes. Similarly, if you look at things like GRI, where companies are already measuring their carbon and they're already breaking them out under the GHG protocol into scopes 1, 2, and hopefully 3, that is useful building blocks for you starting to size up your taxonomy reporting. Now, as I'd mentioned earlier, probably the slight disconnect or asking to go a step further in the taxonomy is activity level. Like, I'm not looking at a cement company's overall emissions, I'm looking plant by plant. And in some cases, a cement company may not know revenue specifically to plant, or you would hope they have started to measure plant by plant emissions, but they might have an estimate model themselves in what they're doing in order to report under the taxonomy, and that's recognized. I think you're fair to say there are bits and pieces cropping up. I know you'd mentioned IFRS, and that's a principles-based foundation. Similarly, I heard mention of like the common ground taxonomy. And personally, I'm in the UK GTAG, so I'm looking at the development of the UK taxonomy. I'm supporting the Mass GFIT on the build out of the Singapore taxonomy. And very much the idea, and you see it kind of nodded to under CSRD in the current draft, is under the Transparency Directive, this notion of equivalence. If I'm a UK company and I'm reporting under the taxonomy, for an EU investor, I want equivalence between the UK taxonomy and the EU taxonomy for me to be able to do my work. So I think that's a step further in evolution that I would encourage and like to see kind of take shape under equivalence. I think that would create some financial certainty for those struggling. The next question you asked was CapEx and OpEx. So I'm a financial market participant. I have an obligation for my underlying investee companies to report the proportion of CapEx and OpEx. I completely agree with you. It is very hard to estimate because you don't have that granular detail around what that capital expenditure is going towards with the nature of the taxonomy. You are likely to be reliant on what a company is saying under their own Article 8 disclosure. So a lot of the recommendations that we make, as Helena mentioned, for international comparability is more on a revenue-based model, because that's how we see stronger disclosure. And I think, as Helena rightly pointed out, if you're marketing a product as an ESG product, you're going to have good disclosure from the companies that allowed you to believe that they were of a sound quality to be within your product. So then creating an estimate model on that data is very possible. And then finally, you asked about do no significant harm and how can Japan align. So we've started to look at this in a lot of detail, actually. So do no significant harm, one of the things I would caution people against is reselling of controversies. Like, do no significant harm doesn't mean controversies. I mean, that may be a complementary skill set, but do no significant harm has a key set of criteria. So for example, under adaptation, when you're looking at do no significant harm for mitigation, there are actually KPIs in there. Kind of what are the carbon intensity levels you would expect of, for example, manufacturing to comply. The way that I look at data and breaking it out for do no significant harm, you have step one, which is entity level. Like, does the company have a biodiversity policy? Have they got appropriate waste management practices in place? So those types of entity level things would be my data set to start with. To complete do no significant harm, I think you can go into some industry specific and activity specific metrics. You can also start to look at relative peer performance, and it's nodded to in the taxonomy when it talks of best in class. So you can see water and waste management practices. Now, you don't need to read into REACH. I recognize the REACH legislation is a challenge, but you can start to say, like, am I doing as best I can relative to my peers in water and waste management practices? Am I year on year improving? So if you look at water and waste and you look at the KPI for substantial contribution, it talks about improvement over a 3-year time frame. You can start to infer the same data set on a do no significant harm basis. So if you are buying third party data on do no significant harm, I think it's really important that the vendor can demonstrate how that correlates under a precautionary principle to do no significant harm. And by precautionary principle, if a company's not saying anything about themselves, we assume they are not meeting those standards. So it's really important that where a company's disclosing, you're marrying it to key terms within the regulation that you think are suitable standards, and then you're saying that you have no reason to believe that that company is doing harm. I hope, Nicholas, that covered all the questions that I wrote down at least.
Yes, at a higher level, we could go into each of those for a day or two. But yes, no, very much so. I would like to close out the panel with a question, of course, Sabine, and to Stefan maybe. Sabine, you made the point about stakeholder involvement and the importance of the quality of data. And I'm still kind of struck, even with what I heard from Nadia just now, well, you can do best effort, you need to improve, but to have trust, you need to have as sophisticated access to data as possible, as reliable access to data as possible. How do we get there? Is this ultimately a question about assurance services? So third party giving comfort that the quality of the data is correct? Is it just having access to humongous amounts of data and thereby, being able to bring it all together? How do we ensure the highest level of quality of data, and what type of an exercise is needed, and what are the processes that you've gone through so far in trying to provide these services?
Yeah, excellent question. I think it's data are collecting from different sources. Of course, the one is coming from everything which is publicly reported by companies, again, the listed one, but also the one we're capturing from all information, the small and medium enterprises, for instance, all over the world are delivering. And for instance, we're able to cover 450 million of SMEs. So it's really huge. On the listed companies, so the data and the system we're developing also thanks to partnership with dedicated partners, where also we are adding that excellency in the data capture with also the production tool we are using. Last but not least, because it's really of essence, and beyond that incredible effort which is done at the regional level thanks to European Commission regulator and the experts. It's also how we use analysts, and I appreciate, and you were mentioning the excellency within the data provider with data analysts which are able to provide beyond the materiality of what is reported and captured, but to provide analysis which are strong, reliable, and again, for which either issuer on the side, also of course investors, are able to discuss about in order to not only check the quality, but also even if sometimes it's information or analysis they could not appreciate because they are exigent and they are really supportive to make us transitioning towards our economy and the objective of net zero. But having that access to excellent experts within data provider is really of essence, and we are really targeting that excellency. We're not only growing our people and developing their existing competencies and capabilities, but also hiring, experts also to increase our capacity to provide really analysis to the market.
Yeah, I think it's interesting the point you made between the balance between factual data and also, let's say, expert judgment. Judgment is always a bit of a dangerous word, but kind of, that kind of qualitative assessment that lies on top of quantitative data. It's interesting to find that combination. Stefan, maybe I'd like to hear anything you kind of have heard and want to respond to, but one thing I would like to come back to right at the end is Nadia's point about building this whole ESG process into your day-to-day process. So, customer appropriateness and suitability testing, risk management, governance, the whole process, so that it becomes part of your life, so to speak. How do you see that? And do you share the view of Nadia that this can be built in over time or quite quickly as part of the natural process? Or do you see that as, in quote unquote, another burden, another requirement on top of everything else, another complexity that, based also on the question that came in earlier today, ultimately might increase the overall cost to the end investor?
Well, yeah, that's an interesting question, and as I mentioned, we are facing quite a lot of demand from our consumers on for ESG products, for ESG funds, and it is only right and proper that we do that in a way that doesn't invite any greenwashing, and that is with that interest in mind, I made my comments. So indeed, it is important that the regulations as we face them actually really match up, that they reference each other, that they are consistent. And if they are, it is a question of just preparing ourselves for the inevitable in any case. So it's not that's how should I put it? It's not a regulatory burden or a compliance exercise. It's obviously a shared mission that we are currently facing in terms of making sure that we can make ourselves fit for the time when ESG is, as I said, not just a niche, but a really integral part of asset management. So as I mentioned, what would be helpful is to have the CSDR coming in as soon as possible, to have the Article 8 standards, Article 8, the taxonomy, to be clear, standards to be applied as soon as possible, so that we have the data that we can use to make our investment decisions. Obviously, it's quite clear that, as Martin already outlined, this will only be done in stages, because it's not only asset managers who call the shots, but also banks and then the wider economy. But having that kind of understanding that we are moving towards a common shared goal, and that we're using approximations and best efforts on the way, I think that came out very strongly from this panel. What I would also like to add, and that applies also to what Martin said right at the beginning, I felt quite heartened that he was talking about the importance of the transition, because not least we as DWS and also Deutsche Bank and others I know have made that point, that the taxonomy as it stands at the moment obviously references transition, but doesn't really help us in terms of making sure that we can influence our clients, our investee companies to become greener. If the thresholds are too high, there's no way they can fit it into the current taxonomy, and it was good to hear that solutions are being found here, because we as DWS are applying an engagement approach. So we are actively talking to our investee companies. We're using our voting rights. We're demanding, as we just did in a letter to 220 investee companies, we're demanding to see how these companies want to make improvements on their emissions. And obviously the taxonomy is not the right place to reference the engagement approach, but using that in the wider legislation, in the disclosure regulation, and making the right provisions for that transitioning, I think that will actually move us quite a lot forward in this agenda.
Thank you very much, Stefan. I totally agree. I think there's this, I know it's been on the cards for a long time, and I know it's discussed certainly with Helena for a few years, but shifting more towards transition, how to build this in without diluting the green aspirations, I think is one of the most interesting kind of developments that we're seeing now coming most likely out of the next action plan. Strategy, I should say. With that, I would like to thank all of you on the panel. I think it was a very engaging, very interesting discussion.